Ladies and gentlemen, thank you for standing by. I am Gaily, your Chorus Call operator. Welcome and thank you for joining the Cenergy Holdings conference call and live webcast to present and discuss the first half 2023 financial results. At this time, I would like to turn the conference over to Mr. Alexandros Benos, Cenergy Holdings CFO. Mr. Benos, you may now proceed.
Thank you, Gaily. Good afternoon, ladies and gentlemen, and welcome to the presentation of the first semester 2023 financial results of Cenergy Holdings. As always, the agenda will cover the main key financial results of the group, then briefly talk about the segment results, and we will finish with an outlook of what the rest of 2023 awaits for us. In the appendix, you will find information on the balance sheet, the P&L statement, financial calendar, and so on. So without much ado, let's go on to the first main conclusions of that first semester. What we observe in H1 is that we've seen a growth in all segments, both cables and steel pipes. And this growth actually makes us very confident about having a strong fiscal year 2023 financial outlook. That confidence is based on the revenue increasing to almost 800 million, 21% year-on-year increase. That is being coupled with improved margins in steel pipes and cable products that drive the adjusted EBITDA at 86 million. And behind all that, of course, is the very important threshold of 2.5 billion that our order backlog reached for the first time in our history, and which keeps growing. We will give some more information on the important awards that were won during the first 6 months of the year. All these things drive consolidated profit before tax to 31 million almost, and gives us the strength to continue our expansion plan in the Corinth plant with a total capex for the first semester of 58 million. Finally, the above will give us the opportunity to confirm the fiscal year 2023 guidance that we've expressed at the beginning of the year for an adjusted EBITDA in the range of 180 to 200 million. So let's see what is the breakup of that 800 million revenue. Starting from the cables projects product line, we see that was slightly increased to 150 million in the first semester of 23 versus that of 22, whereas the products product line increased more significantly to 300 million. Now, what is important here is not, as was stated many times before, is not the actual turnover in the sales, but the profitability which is hidden behind these. For the steel pipes, the profitability goes hand in hand with a very important increase, almost doubling of the turnover of the projects, reaching almost 300 million for the first semester, compared to something less than 150 million in the first semester of 22. The products for steel pipes comprise hollow sections that are not considered significant for the steel pipe segment and have shown a slight decrease due to construction lagging. So, these sales, are they concentrated somewhere or not? No, they are not. As always, Cenergy Holdings is an internationally extrovert group with both segments looking for international sales. And this is confirmed for the first semester of 23, where we see that the percentage for Greece has gone a little bit up due to some projects executed for the Greek IPTO. The percentage of Europe has gone a little bit down, whereas the rest of the world has also decreased, with Americas keeping up the pace and summing up to 800 million. The important thing is the margins, because a turnover by itself would not satisfy such an increase in profitability unless this 21% increase in turnover was followed by an important increase in the margins. And let me give you some more information about that. In order to have that important increase in the adjusted EBITDA, the operational profitability of the group, we needed to have we observed some very good returns on our cables products, especially in the low voltage power cables, and also on the steel pipes projects, since, if you remember, the steel pipes suffered for at least 2 years between 2020 and 2021, 2 very difficult years of lower turnover, very difficult profitability, and a restructuring of the international market. So what does that leave us? It leaves us with a very positive outlook for the rest of the year, since at the basis of that increase in profitability, we find the good execution of cables projects that always produce margins above 20%. This gives us a total EBITDA for the semester of almost 80 million, also significantly improved from last year's numbers, which were a little bit below 50 million. What is behind all that success? Behind that success is commercial presence all around the globe. 2 years ago, in December 21, our backlog for both segments was starting just to get over 1 billion euros. Now we have reached 2.5 billion, and this backlog continues growing. And it continues growing because the markets understand the quality of the products, the services that we provide to the client being flexible towards the client's demands, and the prices that we offer in a very competitive market, for example, the cables products market. That backlog, of course, does not include the cables products segment, since we are talking about projects that either have been signed, contracts have been signed, or projects where the preferred bidder was already announced by the client. So it does not include, this 2.5 billion, does not include long-term standing commercial orders that we do have with certain wholesalers, retail sellers, and so on. Let's see how this order backlog is now distributed across the world. And I will start with the European continent, where we have first a project by CPW in the Norwegian Sea, awarded by Equinor for a deep water pipeline. Then 2 projects awarded in the UK to Hellenic Cables concerning the Norfolk offshore wind zone and Hornsea 3, both for inter-array cables. Then projects in Greece that you've heard of, the 2 connections from Larimna to Aliveri and in Mesatida, near Patras, for a turnkey XLPE underground systems for the Greek transmission operator. Then we go back to CPW, to Corinth Pipeworks, which was awarded an important project in the sea area of Israel, in the Eastern Mediterranean, called Tamar, which is a deep water connection of a gas field in Israel. And finishing with a new 110 kV submarine interconnection in the Adriatic for Croatia, and 3 important projects awarded in Germany: North Sea Cluster for inter-array cables, Dolwyn Kappa, the offshore grid connection for the platform of TenneT. TenneT is the German transmission operator, and the latest project awarded, and one of the biggest ones that were ever awarded to the group, the Genaker project, which is an EPCI, so a turnkey contract for an interconnection between the Genaker offshore wind farm and the German grid. And the orders in Europe kept on coming. So we go back now to Denmark, where we had in May the Thor offshore wind farm to supply export and inter-array cables for the Thor offshore wind farm in Denmark. Then we have the Baltica 2 project in Poland for another offshore wind farm. The Leviathan deep water field project by Chevron again, which shows the confidence and the trust that this very big oil and gas player has towards Corinth Pipeworks for a complicated deep water project. Then in Tréport, the offshore wind farm in France, where we supply inter-array cables. And I finish with 2 CPW projects, one in Holland, the pipeline NO5A by Onedias, and finally 3 offshore projects that were awarded in the beginning of September and disclosed the beginning of September for Aker BP in the North Sea. These ones cover just Europe, but we also had, since the beginning of the year, 2 offshore wind farms and the inter-array cables awarded to us in the US, in the eastern coast of the US, which shows that our presence in the US and our awards in the US keep on coming. Does that affect our profits? Of course it does, and it shows very clearly in increasing almost 50% the profit before tax, the bottom line, and consequently increasing by a relative percentage the net profit to 24 million for the first semester. Now, that profit before tax came at a period which was not the easiest one concerning the macroeconomic condition. And I would like to step back a little bit here and discuss how did we arrive to a 31 million PBT in the first semester of 23, starting from 10 million lower in 22. First, of course, we had the profitability of both segments, most importantly, the steel pipes. The steel pipes gross profit that gave us 27 million compared to the 4.2 or 3 million the corresponding semester of last year. That growth in profits, of course, had to be supported by expenses to keep up the work going. The 5 million that you see as selling and administration expenses concern training of the employees, new FTEs to support the production lines, which are considered as necessary expenses for growth. And then we had quite an important impact, negative impact, by the net finance expenses of almost 20 million, which came not as a result of increasing net debt, but mostly as a result of the shock that the interest rates had during these 12 months between June 22 and June 23. And to be a little bit more specific on that, if we go back to June 22, the 3-month Euribor was slightly negative at 18 to 20 basis points, negative. If we look at the 3-month Euribor in June 23, it's over 3.6%. That impact, we tried as Cenergy to lower it, to mitigate it by going back to our financial partners and negotiating with them the credit spreads. And to be honest with you, Greek banks and international banks tried their best to decrease the credit spreads that we're offering to Cenergy's subsidiaries. But these decreases, of course, could not cover the 350 basis points increase of Euribor. That impact was enough to more than double financial costs from the first semester of 22 to the first semester of 23. So we were at 14 million for the first semester of 22. We are at 32 in 23. And from what I understand, the macroeconomic condition will not change so much in terms of reference rates in the next 6 months. All of that, of course, was the defining factors in order to get to 31 million at the end of the year. So the profitability, mostly of Corinth Pipeworks, was enough to cover the extra financial costs. Now, is the debt something that will concern us? It is true that net debt has increased in the first semester of 23. It increased by 90 million. Most of that increase comes from an increase in working capital by 50 million, 55 million. Why was that increase in, where is that increase in working capital due? It is due to some temporary different time alignments of, on the one hand, milestone payments from certain projects in the steel pipe segments that were moved forward to the second semester of the year, as well as payments of raw material suppliers for projects that the steel pipes had already secured at the end of 22, and the raw material suppliers had to be repaid in the first semester. So the payments towards suppliers and the moving forward of the milestone payments from our customers caused that 55, 56 million change in the working capital. Is that something that we are expecting to reverse? Yes, it is, because the payments that we were expecting to get in the first semester have already been received in July and August. B, The raw materials for projects that are now being executed are already covered and paid. So whatever is coming back now and invoiced now will be shown as EBITDA. And in a sense, if we look at the EBITDA of the 6 months, the 80 million EBITDA, that would be enough to cover the increased financial costs and the increase in working capital. So the cash flow from operating activities would be enough to cover the profitability, to cover the needs of both segments, if it was not for the finance charges. So yes, the net cash flow generation is negative, but it is negative due to the very high finance costs. How will that be reversed? It will be reversed, as I told you. First of all, because now the working capital increase is expected to smooth out until the end of the year. And secondly, most importantly, the very strong profitability of both segments. We have announced something which is in the areas of 80 million EBITDA, 89 adjusted for the one-offs. That is expected to continue in the second semester. That is why we will reconfirm the EBITDA guidance that we gave for the full fiscal year of 23 from 180 to 200 million. And keeping the leverage, even with this increased net debt amount of 530 million, keeping the leverage even now at the areas of 3 times EBITDA. Now, in all this environment, what does the group continue to do? It continues to invest in its production lines to make sure that we can service the backlog, which is already strong and it is growing. So the major expansion of the Corinth plant is continuing. That needed almost a capex of 80 million over 2 years to address the growing demand coming from an accelerated transition to a low carbon economy. If you look at the last 3 years, from 21 to 23, we have spent as Cenergy more than 180 million euros in capex. That will continue, maybe not at the same rhythm, but it will definitely continue, because our focus is on keeping our products at the frontier of technology and servicing our clients as best as we can. Financing, of course, for that capex of Fulgor was secured through EBRD and IRF, as we announced earlier throughout the year. I will now turn briefly to an overview of each segment, starting from the cables. Cables, as is clear, continues on its growing path. The turnover is close to 500 million. The adjusted EBITDA shows a margin of more than 12% for the first semester, compared to 10% in the corresponding semester of last year. And this, of course, translates into a good profit before tax. Working capital for cables has gone down, but their net debt has increased because of the capex expenses that I've talked about in Fulgor, Thiva, and so on. Let me remind you also that we have acquired an industrial plot near Thiva, the ex-Petzetakis factory, where we now do some revamping works in order to make it ready for relocating some part of the production next year, some part of the low voltage and fiber optics cables production next year. So we had to clean up the area and be able to relocate first some warehouses, then some production lines and so on, but that will come in 24. The real success story, of course, as I told you, is steel pipes. And it is a success story because we see a very important increase, more than 50% for its turnover, which crosses the 300 million mark at the first semester. And also it crosses the 27 million mark for adjusted EBITDA in the first semester, compared to 4 million in H1 of 22 and 6 million in H1 21. If you compare that number to the full year profitability of 22, it's still higher. So in the first semester of 23, steel pipes could cover all the profits that it had throughout 2022. And it's coming even stronger. It's coming stronger because, as you've seen in the backlog, it has secured some important projects, especially in the Eastern Mediterranean. And secondly, it's coming stronger because it has now acquired what we call first-tier supplier for the large oil and gas, hydrogen transporters, carbon capture market, and so on. I will give you some more information in a while. So what does that leave us? It leaves us with a success story for the future. It gives us good visibility. The backlog of steel pipes gives good visibility for at least 2 years in the future, and the margins are strengthening up. So finally, what do we expect for the end of the year? I have to be clear here, the success of one semester does not make us overtly optimistic for the rest of the year, but it clearly makes us trust our products and our people for the international market. And what do I mean by that? This good financial performance needs good products and good people behind it. But it also needs some good market conditions. And if you look at the cables market, and I'll start from there, the world, as you know, becomes electric. This is clearly and evident from every news source that you read in your information sources. It is expected that the electricity demand will increase by 80% until 2025. It's also expected that the old grids that exist in Europe have to be revamped, have to be refurbished, because they are more than 40 to 50 years old. The e-mobility is between us. You all know someone, or you drive, either you drive an electric car or you know someone who drives an electric car on an electric scooter, which means that the demand for charging stations, and therefore for cables, will increase by 2030 by 17 times, 17. These are the projections of the International Energy Association and Europa Cables. And at the same time, we have even the heating production getting into being electrified. So that creates a very important demand for cables products. And that's why we believe very much that the margins in the cables products business line will remain at these levels for at least a year. Secondly, for the projects, we are all reading every day in the newspapers that there are more and more projects being announced in the offshore, but at the same time, we are reading of some hiccups in the international offshore market. So what I would like to make clear here is the following. The offshore wind market is necessary for the Paris targets and for the decarbonization of the economy. Without an offshore wind market, you cannot achieve the targets that you have for electricity from renewables. Solar and onshore wind, which is already kind of saturated, cannot cover that extra step. So you need offshore wind. What's going on right now in the world is that you have a renegotiation phase where the offshore wind developers are trying to renegotiate the conditions that these wind farms will be operating in the future. Mainly in the US, that's why certain large developers have announced that they are rethinking the setup of their farms in the US, because they are expecting the IRA, the Inflation Reduction Act, to give them more tax credits and more and stronger financial incentives to keep up the production of new renewable wind farm renewables in the US. And secondly, they are rethinking what will be the price at which this renewable electricity will be produced. We all know that renewables, when they started coming into the market of electricity, were an expensive sport, if I may call it like that. Our experience has shown that these prices have gone down for solar and for onshore wind. And we are more than sure that these prices will also go down for offshore wind. The demand is there. It might be postponed for some time. It might be restructured, but without offshore wind farms and the demand for cables, for interconnections, for export cables and inter-array cables, this cannot be achieved. So the demand will come. Looking at steel pipes, I also have to reiterate our conviction that the gas fuel sector will continue its growth. Why will it continue its growth? Because even the most conservative outlook for the natural gas market shows it to peak around 2035. This is more than 12 years ahead, which means that the demand for steel pipes, which will serve that natural gas demand, will peak at the worst at 2030. So we have at least 5 years in front of us. The steel pipe segment has at least 5 years in front of them to get to win projects, to produce steel pipes, large diameter steel pipes, which are their strength, and to keep being a tier one player in the market. At the same time, they have already diversified. So which are the two other products on which they have put a lot of focus? Hydrogen and carbon capture. Hydrogen, needless to say, that hydrogen will be, that it's again an expectation, that the demand for hydrogen will increase by almost 4 times until 2050. We all know that hydrogen is the gas fuel of the future, especially for industrial applications and large transportation. And this is indeed linked to the demand of offshore wind because we are talking about green hydrogen. When I'm saying hydrogen, I mean all the different types of hydrogen. The gray one, which we are now using, which comes from the extraction of oil and gas. The blue one, which comes from the same extraction, but it includes some carbon capture. And the green one, which will come from electrolysis of water. In order for hydrogen to reach these levels of consumption and these levels of industrial use, we need to get to offshore wind farms. Now, what will be needed to transport this hydrogen? You will need pipelines. The expectations of the International Energy Association are that 70% of the transportation of hydrogen will go through pipelines and not through sea transport. So we will need some large networks to be revamped, to be refurbished, because gas networks exist, and 30% to be rebuilt from new. And parallel to that, we have the decarbonization tool of carbon capture. And the carbon capture market is expected also to grow in the next 5 to 7 years, especially for sectors which are not easy to get to their green targets by 2030 without carbon capture. I'm talking about iron, steel, cement, and so on. So what does that leave us? It leaves us with a market, an international market for steel pipes, which right now is focused on natural gas, but where Corinth Pipeworks is already ready to tackle the new markets of hydrogen transportation and of carbon capture. All of the above permit us to be quite optimistic about the end of the fiscal year 2023, and that's why we reconfirm the guidance that we gave to the investor community at the beginning of the year, from 180 to 200 million of adjusted EBITDA, and we look to a very positive 2024 as well. This concludes the short presentation. I thank you for your attention, and I turn it over to Geli for your questions. Thank you.
The first question is from the line of Bourazanis Marios with Eurobank Equities. Please go ahead.
Good afternoon, and thank you for your time. Also, congratulations on the solid
Mr. Bourazanis, this is the operator. I'm sorry to interrupt you, but we cannot hear you very well. Can you please speak a little closer to your microphone?
Yes, I'm sorry. So, good afternoon from me, and thank you for your time. My first question is if you could give us some color on the net debt to EBITDA ratio for each division, so for cables and steel pipes. And my second question is if you could give us an insight on the current value of the backlog, so the value in September for the group and also for each division. Thank you.
I missed the second part, Mario, of your question. Could you please repeat it? Because I missed the line is not very good. Could you please repeat the question?
Yes, I'm sorry. So my second question is if you could give us an insight on the current value of the backlog, so the value in September.
So let's go back to the first question. You are asking about some breakup of the net debt. What is clear is that the net debt of 527 is expected to go down by the end of the year. The increase of that we've seen in the first semester is mainly due to the steel pipe segment because of the working capital needs. The cable segment tried to tackle that and to smooth out the need for more money in the first semester. So it's expected that the most important job will be done by the steel pipe segment for the second semester. Cables are already working at a stable working capital percentage of their turnover, and the only, not unknown, and the only part where the debt will be used is for capex, the capex of Fulgor, the expansion of Fulgor. But this is already planned, so there is no difference there from the numbers that we have announced already. Out of the 54 million necessary as capex for the cable segment, the largest part, more than 40 million, are used in the Fulgor plant. So we expect exactly the same amount to be used also in the second semester. So the net debt reduction will come from Corinth Pipeworks with a good management of the working capital needs and their strong profitability. As for the backlog, you're absolutely right. The backlog of 2.5 billion is the number that is shown on the 30th of June. I cannot definitely disclose a number for September, but if you look at the announcements that we made after the 30th of June, and especially the latest one of the Aker BP projects for CPW, the Genaker project, which was announced at the end of August, and the Leviathan project, all of these will clearly give you a very good impression of where the backlog will be at the 30th of September. Otherwise, you should wait until the 16th or the 17th of November, I think the 17th of November, when we will disclose the trading update for Q3. But I assure you that the backlog has grown since the 30th of June.
Thank you very much.
Ladies and gentlemen, there are no further audio questions at this time. I will now pass the floor over to management for any webcast participant questions. Thank you.
Thank you, Geli. Yeah, we do have two questions from the webcast. The first one comes from Mr. Katsios of Optima Bank. He would like to have some more light onto the financial expenses. So what we should expect the financial expenses to be for the full year. Well, Nestor, I cannot say nothing more than having the same financial expenses also for the second semester, because unfortunately I do not see any decrease in the interest rates coming up. So the 32 million is a very good number to double for the full year. Our debt is mostly variable. There is a large part which has been fixed through the use of financial derivatives and swaps, as we disclosed last year. We definitely have signs of lower debt in the second half, but we should not forget that the financial costs of the second half will concern the debt which is already open in the first half and should be and actually earns interest for the second half. So the effort that we will make to decrease net debt by the end of the year comes mainly in the decrease of working capital, so short-term lines for the steel pipe segment. And it seems that they will achieve that. There is another question that comes from Paris Manzavras of Pandelaki Security. He would like some more elaboration on the 450 million Genaker project, the largest ever awarded to Cenergy. Now, as you understand, Paris, the information that we gave to the investment community is the information that we could give because of confidential agreements with the suppliers and the customer. It is, however, clear that, A, we have a project in Germany from a very important customer that awards an important part of its export cable system to Hellenic Cables. This 450 million turnover, of course, will not be realized in 6 months. It covers a much longer production time. We should read it, we are reading it, and I believe that the investment community should also read it as an increased level of confidence and a new letter of confidence, letter of reference for Hellenic Cables. So it shows that even the hardest customers in Europe, like the German TSO, like, to go to the CPW level, Equinor, which is a very difficult client. We're talking about the ex-Statoil in Scandinavia. So we have difficult clients being convinced of the service and the quality of both segments and awarding more and more larger and larger important parts of their needs to the two segments of Cenergy. That doesn't make us party, not at all. We are not partying, we are not really party types, we are more types who are focused on delivering something good. That's why we have also given the guidance for the end of the year, and we are confident that we will achieve that guidance, and we would like the market to believe in what the management is doing and what our employees are doing and what our people are doing, and we want to prove to the market community that the awards and the projects are not just cause for celebration, but they are cause for hard work. That leads us to the next part of your question, Paris, the expectation for full year 2023 CapEx. Also, I would say that a very safe estimate is to take the first half CapEx and multiply it by 2, at least, because we have the Fulgor expansion plan running at good pace, as expected, and we also do have the small expenses that will be necessary for the Petzetakis land plot. So overall, with CPW going in at the maintenance level that they have every year, we are expecting the full year CapEx for 23 to turn around the 100 million mark. There is another question by Alex Boulogouris of Eurox. What are the EBITDA margins in the second quarter? They are slightly lower than the first quarter. Alexi, you're right. This is due to the product mix, absolutely. Because you have certain products in CPW which have higher margins, certain other products and projects in Hellenic Cables which have slightly lower margins, but overall, the margins for the 6 months are higher for the whole of Cenergy than what they were the corresponding semester of 22. So it's a mix. It's definitely what you're saying. It is due to the product mix. It has nothing to do with demand slowing down or markets being tightened and so on. Nestor, he has also another question from Optima Bank. He asks, is there any case that the new line in Fulgor will be operational before 24 and have some limited contribution in next year's performance? Nestor, no, I don't think so. The plan is for the expansion to finish at the end of 24. Even if it finishes slightly ahead, there will be some time needed to test the new line. The focus of everyone in the plant is to execute the projects that are important for us right now in a flawless manner. We don't want to jeopardize, by rushing up the investment, we don't want to jeopardize the production of projects which are already running. We are already, of course, employing more people in Corinth in order for them to be ready after training for 25. This happens right now, but that does not mean that we are rushing the construction phases and the setup phases of the machinery. The plant, and I'm sure that you know that since you may have visited the plant close by, the plant is a sophisticated plant. It needs some attention to how things are organized and how production is organized. So we are not ready to put at risk the execution of a project that runs right now in order to shorten the completion of the investment by 1.5 months, by 40 days. That will not make a difference in our financial results. We want the plan to be working perfectly at the beginning of 25 so that it can bring up the full potential of the investment that we have done. I don't know if there are no other questions, Geli, from the webcast. I don't know if we do have some time for questions from the audience, if someone wants to ask something.
Mr. Benos, there are no further questions on the audio. Ladies and gentlemen, the question and answer session has been completed. I will now turn the conference over to Mr. Benos for any closing comments. Thank you.
Thank you, Geli. So thank you all for following this presentation of the 2023 first semester financial results. I am sure we will have you with us in November for Q3. And we are clearly optimistic and confident that the growth in our segment, in both our segments, will continue. Thank you very much. Have a nice afternoon.